Current account deficit is narrowing. This year we expect deficit to be meaningfully less than 3% of GDP, hopefully around 2.5%. That should enable us to also accumulate reserves. Is the program working? That's the main components of the program. The program is working. The program is meant to work this way: a combination of sound policies and structural reforms offers a great narrative. And on that narrative, we hope to regain investor confidence, which is happening, and that leads to portfolio preferences, in favor of Turkish assets, leading to real exchange rate stabilization or some appreciation, and that fosters strong disinflation. And at the heart of it is rebalancing growth, improving composition of growth, making it sustainable, more balanced growth. As you can see, the market has noticed Turkey's CDS, which is the risk premium, has fallen by 439 basis points over the last year, while emerging markets, decline in emerging market risk premium is only 53 basis points. So as you can see, there's been a dramatic improvement in risk perception of Turkey. Similarly, if you look at the spreads, the red one is Turkey, and the blue one is MB+, Emerging Market Universe. As you can see, we have decoupled in a positive way. We are overperforming. So Turkish spreads are narrowing much faster than the emerging market universe. Exchange rate volatility has declined. That doesn't mean lira is not weakening, because inflation is still high in nominal terms. There will be some weakness in lira, but the volatility has diminished. And if you look at emerging market volatility band, it's well within there compared to pre-program, which we were, again, an outlier. Growth composition is improving in terms of domestic demand and net export contributions. That's likely to continue to be the case. Current account deficit is narrowing dramatically from $57 billion to about $30 billion as of March. It's likely to fall meaningfully below 30, which will amount to about 2.5% of GDP. And as you can see, there is a divergence, positive divergence, in net portfolio inflows. Again, the blue one is emerging markets, the red one, post-local elections, there's been significant capital inflows, portfolio inflows into Turkey. And external debt rollover ratios have gone up dramatically for banks to over 150%, for non-financial corporates to close to 120%. So as you can see, there's been a significant turnaround. Central bank reserves are up by about $36 billion, quite strong, and we are exiting the so-called protected lira deposits. Again, the share of lira deposits have gone up by nearly 14 percentage points over the last year. So confidence is returning. There's a preference for local currency assets. Inflation expectations are also improving. As of May, 1 year ahead inflation expectation is about 33%, and 2 years ahead is about 21%. This is still slightly ahead of our targets, but we believe that as inflation falls, it will converge with our targets. Credit rating, obviously, improvement is also welcome. We've had 2 rating upgrades, and more are likely to follow because all of the credit rating agencies have positive outlook. Why would you consider investing in Turkey? Well, first of all, we are addressing challenges. We're fixing structural problems. That will create value. That's number one. But let's look beyond it. Let's look at the structural side of why you should invest in Turkey. Well, structurally, this is a big market. When we say it's a big market, Turkey is as big as 15 to 17 EU member states when it comes to population, working age population, GDP on PPP or GDP even at the current exchange rates. So as you can see, whether you look at various indicators, Turkey is as big as over a dozen EU member states. It's a big economy. Last year it was over $1.1 trillion at current exchange rates, but also it was $3.7 trillion on a PPP basis. Okay, it's a big economy, but is it growing? Yes, it's growing. The dotted line reflects Turkey's 21-year journey in real terms. So this is GDP in constant prices, in real terms. If you take 2002 as your base year, just to take a 20-plus year perspective, as you can see, emerging markets, excluding China, India is the yellow line, and Turkey is the red dotted line. There's a strong overperformance. Of course, China, India are continental-sized economies. We have a good infrastructure. That's what World Bank says. Maybe not as good as, of course, GCC countries. We've invested very heavily in infrastructure. This is a 20-year journey in dual carriage highways and motorways in Turkey. Turkey is a big country, and we've really invested very heavily. We invested about $280 billion over the past 2 decades. That's why the need for investing road infrastructure has diminished for the next 30 years. There's not going to be much investments.